What's up, guys? I'm nobody special, and the bond market is flashing a warning signal. If you guys are looking at this chart, do you see what I see? That is your classic death cross about to happen in the 10-year treasury yield. And if you're new to technical analysis, a death cross is about the single most bearish indicator you could possibly have. Now, before we get into that, if you guys wouldn't mind doing me a favor, I have to say, could you please hit that like button, subscribe to my channel, hit the notification bell. It would really help out this channel. I would be forever in your debt. Now, that being said, let's talk about this death cross because this could be big. Now, if you're new to technical analysis, a death cross is when the 50-day moving average crosses below the 200-day moving average. And here is the blue line. That is your 50-day moving average. And the red line is your 200-day moving average. And they're about to cross. The 50 is about to cross below the 200. And I'm sitting here. I have Ghostbusters playing in my head. Don't cross the streams, Ray. Don't cross the streams. Imagine every cell in your body simultaneously exploding. Right, got it. Cross the streams. Bad. That's good. But this has happened before. We've had death crosses before. Let's zoom out on this chart a little bit. And here we can see the last time we had one of these death crosses was January 14th of 2019, around that time frame. And look at what the yields on the 10-year treasury have done since January of 2019. Down, 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 down. Now, if you remember back in January of 2019, I know that seems like forever ago, but this was just following the Christmas Eve panic in 2018. And that was our first indicator that the era of easy money had gone on for too long and that we were trapped in this cycle of low interest rates and quantitative easing. I don't know if you remember back then, but this is after our first few consecutive rate hikes, and Jerome Powell, still the chair at the Fed back then, and he was doing quantitative tightening. They would say, we're unwinding our balance sheet, which meant they were basically taking previously printed money out of the economy. As the debt matured, they didn't print money and buy new debt. They were just destroying the money, right? So the money supply was shrinking. At the same time, interest rates were going up. And that caused panic in the stock market around Christmas Eve 2018. And that was the first sign that the era of funny money had gone on for too long and we were trapped. And Powell had to very abruptly start lowering interest rates. They started, there was a couple of consecutive times that year that they lowered interest rates. And I remember thinking that's odd because we were at a time of like peak prosperity in the U.S. Economic growth was like 3.5%. GDP was growing 3.5% year over year. Housing markets were doing well. Stocks were doing well. And I remember Trump's Twitter tirades. He was blasting Jerome Powell on Twitter saying, as only he could, my economic numbers are so glorious, even though I have to fight the Fed because Jerome Powell is siphoning $50 billion a month out of my economy. Well, that was Trump complaining that his GDP growth would have looked even better if it wasn't for the Fed's quantitative tightening. Now, there was some truth to that. Whether or not that was presidential is up to the reader to decide. But that was the first indicator that something was fishy. And rates started going south shortly after. And then we had that death cross in the 10-year treasury yield. And then a few months later, we had another big drop right around September of 2019. Remember the repo crisis? And remember all of a sudden they started printing again? That was your second indicator that the era of funny money had gone on for too long, when there was more demand for cash than there was cash in the system, and the Fed had to all of a sudden go from quantitative tightening to quantitative easing. And that happened in September of 2019. That was the second indicator that the era of easy money, low interest rates, and quantitative easing had gone on too long. And then, of course, we had the pandemic, and the rates went to near zero. Now, the opposite of a death cross is a golden cross, and that's what we had here back in November, right around Thanksgiving time, where the 50-day crossed above the 200-day. And the golden cross is one of the more bullish signals. That means yields were poised to go higher, and of course they did for the whole first half of the year pretty much. Yields marched higher, and then they turned and they're heading south again. So So the death cross and the golden cross are very powerful indicators. Now, I want to point out that they're not perfect, right? Because we had a death cross here back in July of 2017, right? And yields did go a little bit lower after that death cross, but they popped higher and continued higher after that. So it's not a perfect indicator. And again, back in summer of 2017, that's when the Fed was still hiking rates. So we probably could have predicted that that death cross wasn't for real. And then, it corrected. We had the golden cross, and it went much higher from there. So this is not a perfect indicator, but it is a very strong indicator. And the fact that the bond market is giving us a death cross right now, at least my interpretation of that, is the money doesn't believe Powell. They don't think he's going to taper. And I would handicap it at 50-50 because, man, Jay Powell has a poker face. I would never play poker with that man because he emotes nothing. He does not show what he's thinking. And to be in his head, would be $1 billion value right now because he determines the fate of the global economy. I mean, not just him. There's the whole board of Federal Reserve governors. But he is the chairman, and he tends to get what he wants. But this is the bond market saying, Jay Powell, we don't believe you. You're not going to taper your asset purchases. We think bond prices are going higher, and thus yields are going lower. Remember, bond prices and yields are inversely correlated. This is the bond market saying, I think bond prices are going to go higher. I think interest rates are going lower. I think Jerome Powell is going to buy more treasuries, not less. They don't believe what Jay Powell's saying. I would put it at 50-50. I can tell you what happens if he starts tapering. I mean, the last two times we had any kind of a hawkish move from the Fed, right? We had the Christmas Eve panic, and we had the repo crisis in September. So we've already seen what happens when the Fed makes a hawkish move. The economy doesn't like it, and the Federal Reserve quickly pivots and becomes more dovish. So maybe that's what this golden cross is saying, that maybe they're going to taper, and it's going to cause a panic, and they're really quick going to go right back to QE. But if we zoom out far enough in this chart, we can see a trend here. Go to a 1 year, and we zoom out a couple of years. Let's go to a 5 year. Zoom out a little bit more. I mean, look at what rates have been doing for the better part of the last 40 years. I mean, since the end of the Volcker era, fighting inflation in the 70s, rates have just gone, up and down, but down, 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 staircase down. And zero is getting a heck of a lot closer, isn't it? And this whole time, the Fed has had their dual mandate of maximizing employment and minimizing inflation. Leave it to you to decide what kind of job they've done of that. But if you look at this chart tells me rates are going lower over the long term. Now, the last time we talked about rates, let's switch back to like a 1 month chart here. The last time we talked about interest rates, we were right around here, around August 13th. And we were talking about how, they were closer to here, how it was testing its 50-day moving average and heading back down. And, I asked you folks for your comments. Do you think rates are heading lower from here? Most of you said lower, and most of you were correct. We went lower over the next few days. Now we've come back up here, and here we are today, pretty close to where we were a few weeks ago when we talked about this. Rates have retaken their 200, retaken the 50. Did they stay here, or are they headed lower? Again, I would put it at 50-50. I don't know what the central planners are going to do. I mean, I would tell you based on the trends and based on the death cross that rates are going to go lower. But ultimately, it's up to the Fed. It's up to Jay Powell. What we do not have is free, fair market capitalism. We have central planning. So it's up to him. And I can tell you, it's not just about whether he tapers. Because there's, $4.5 trillion more spending working its way through Congress right now. 1.2 trillion in infrastructure, 3.5 trillion on God knows what. That's all going to hit the bond market at some point. The government is going to borrow that money. And if all that new supply hits the bond market and all other things stay equal, then bond prices would drop and yields would go up. So not only does Powell forget about tapering, Powell needs to dramatically increase his asset purchases just to maintain the status quo right now. I don't know if he's going to do that. But we're rapidly approaching this crossroads where the era of easy money has gone on for too long, and we need to make this choice between the everything bubble and the dollar. We can't keep both. One of these things has to die. Either the dollar dies through hyperinflation and the asset bubble continues inflating, or the dollar goes up in value and the asset bubble pops because of higher interest rates, and the stock market, the bond market, precious metals, everything goes down. I don't know which ones they're going to choose. They probably should choose to deflate the asset bubble. I mean, but the time to do that was a year ago, was 2 years ago, was Christmas of 2018. They didn't have to lower interest rates back then. We could have taken the pain back then, and it would have been painful. But we chose not to. We chose to lower rates, and then we chose to increase QE again, and we inflated the asset bubble further. We are approaching this point where we have to make a decision between the dollar and the everything bubble. And if you talk to most of the folks in the silver community, in the precious metal community, they'll tell you Powell ain't going to taper. And I'm inclined to agree with that, because whenever I'm at trying to gauge what someone's going to do or what happened or who caused it, the question I always ask myself is who benefits? And in this case, how do the most powerful people in the world benefit most? And that is through the inflation of the asset bubble and the destruction of the currency. Because the super wealthy own assets that generate commodities or a return. So those things will rise in price as inflation erodes away the currency. And they also have a lot of debt because they borrow against their assets for their income. That's why they pay nothing in taxes. Well, hyperinflation also erodes the debt and makes that debt easier to pay off. So the super wealthy, the elitist, the ruling class benefits most from continuing the inflation of the asset bubble and destroying the value of the dollar. So for that reason alone, I would believe this market signal and this death cross that we're probably headed lower in rates, at least over the long term. That's all I got for you guys today. I hope you enjoyed this video. Sorry for the Debbie Downer note there. I didn't mean to depress everybody. But I want to thank you guys for your time. Thank you for watching this video. Again, please give me a thumbs up, subscribe to my channel, and hit that notification bell. It would really help me out, and I'd be forever in your debt. Guys, have a good one. In the meantime, live small and dream big.